Hi everyone. So this is an update for the end of July here for the portfolio. So we can see the current value has reduced from the top at peaking at around 16,500 to currently around 16,090. That may have increased after today's gains. However, in the long run, we'll continue to chart this and see how it develops in the future. So what's important to see here is that we have the stocks portfolio value here on the left and the dividends received. So it's been good to see the dividends received through the holdings since last June have increased significantly. So over the last year we've had £253.36p, and in 2021 alone we've had £215 of that. So it's great to see that the dividends are increasing. We can see a very large one offset the average in May, so that was predominantly from Aviva and Legal and General. However, they have reduced since that, with some more in the future coming next month. So it'll be good to see when most of the English companies pay sort of biannually, it seems. So it'll be good when some of those stats come in, but it will be a bit more irregular on how this graph looks. You can see that the trading 212 is up to 13,940 with a total invested amount of just under 14,400. We've seen a large reduction in the value of the portfolio in the last week, predominantly through some of the recent earnings and some of the holdings, and I enjoy it. It's a good time to buy. We've had the lowest return here as a minus £810, which is just over 5%, 5.63%. However, that is a great opportunity, as I have high conviction in these larger holdings and will continue to buy them. So, as you may notice now that Burford Capital is the highest valued holding in the portfolio. So recently, if you go into Burford here, currently 3% down, so £56, with a total invested value of just over 1,860. I've continued to buy this, so I initially bought it sort of around 850, and I really like the valuation at that price. Subsequently, it has fallen, and I've continued to buy as there's no change in the fundamentals of the company. So you can see here on the history tab, just some more purchases have been made at 767, 731 seen on this fill price here, and the largest at 758, £7.58 here at 300. So I'll continue to look into buying that one, as I believe it is a great company and some great future returns ahead. Another big new purchase made is Alibaba. So you've probably seen this quite a lot. I'm going to shortly show a clip from Mohnish Pabrai around some of the virtues of Alibaba. Given the recent regulation concerns in China, I don't see it as a large issue. If you actually look at the regulations that they're bringing out, it's mainly just to actually make the market fairer, so to allow more competitive nature with Alibaba and Tencent, and just try and get rid of some of the monopolies that were developing in the Chinese industry. And there's some rumours of the credit check information getting shared with the government, which, as some other people may have pointed out, is actually commonly done all around the world. So I'll show this clip from Mohnish, and it's a great way to see what his virtues are when buying Alibaba.
I mean, if you look at my filings, you can see that we have a position in Alibaba.
Mm-hmm. And yeah, we'd love to talk about Baba, because that they're in the news all the time, and they're competing head on with kind of U.S. big tech. They also have Chinese tech to compete with Tencent. So, what's your overall thesis with Baba?
Well, it's an incredible business. I mean, if you look at Baba and Tencent and kind of where they're at, and the ecosystem and the moat and what they control, and all of that, look at the tailwinds from China. I mean, there's a lot to me to like, even more than the large US tech, just because I think that the tailwinds are so much stronger, and there's some serious barriers to entry. But on the other side, it cannot do what RACES can do. What I'm saying, I buy a 20 million market cap, which has liquidation value of 800 million, that's a 40x.
Right.
And it's a 40x with no future value creation, just the arbitrage of price and value. I think here there is obviously going to be uh, much larger revenues and profits and such in the future with all the different things they have going on. But you're starting from a very large base.
So that was the video there from Mohnish. It's great to hear. As we heard, if you follow him as an investor, you can see that this isn't his typical investment where he's going for sort of the cigar butt approach from Warren Buffett with the very undervalued companies that are on paper trading a lot less than their actual net asset value. So it's great to see that he's not expecting this to be in that case. So you're not buying something less than the working capital, for example. You're buying a company currently at a very low valuation with expected very high growth in the future. I believe that Alibaba has had a recent compound growth rate around 50%, so that's very high. Obviously, as size increases, that rate will reduce. However, as we've seen with Apple in the last earning quarters, it's still accelerating greatly. And Alibaba's got a great position to expand across Asia, across the largest population center in the world. So the huge customer base with a rising GDP per capita in China and the rest of Asia. So it's got some real good tailwinds behind it. Later on in that video, he goes along to say how the Chinese government aren't likely to try and hurt the Chinese companies too much, just given it's their crown jewel. And other than the state-owned enterprises and the Silk Road Initiative, it's companies like Alibaba and Tencent that give China that global footprint, and also in a sort of better light than they may be seen. It's a good PR for the Chinese Communist Party. Obviously, the one thing in China is you don't talk bad on the Chinese government, so that's just what I see the recent regulations being. There's a bit of a cracking of the whip for these sorts of companies. So moving on to the other portfolio additions. So we've had ASOS here, which I will go into more detail in a future video. So it's recently dropped in sort of 18% in price. So the PE as a sort of basic ratio is not 36. So if we go do a quick Google, we can see that it's currently around 21.8. The reason I'm buying ASOS is they've had excellent growth, around 20% every year in revenue growth. It's in an industry that personally I know someone working within the actual merchandising of this at a competitor, and ASOS has a great business. They're expanding into their own lines of clothes, so they're increasing their margins, as the margins have been recently quite suppressed given they're selling other brands' clothes. With the acquisition of Topman and Topshop purely in cash, they're able to grow their audience and the number of products that they sell as a company with higher margins. A company that's been hit relatively hard recently as well, one of the top holdings here is Intel. So Intel's fallen quite a bit recently. Their recent earnings were flat, so they weren't posting the best earnings. We can see here revenue was flat Q2 versus Q2. It's actually minus 0.5%, but we can't really look at that. So if you look at a non-GAAP basis, you might think, why is that less? It's because they're selling their NAND part of their business, so they've not included that in the non-GAAP part. However, the revenue's flat. The gross margin has increased, which is good to see. This is actually roughly 10% higher than AMD's, predominantly due to them manufacturing their own chips. Their R&D spend has gone up 11%, which is very good to see, and their tax rate has been reduced, but that's down to some accounting. So it's a sort of anomaly. It's not unique to this quarter. So I'm going to quickly show a video here from Pat Gelsinger, who's the new CEO at Intel. It's really good to see his energy and how he challenges the market and is bringing Intel back to the forefront of the chip space.
How do you anticipate your key competitors responding to what you put forward last night?
Well, I think every one of them is going to say, oh, can they do it, right? They've been stumbling for a while. Yes, we can. Oh, our products are good. Well, ours are going to be better. Boy, they haven't been good suppliers lately to the different competitors or the different customers in the industry. Well, we're coming back and we're rebuilding those relationships. We saw market increase in customer scores just over the last couple of months. We're going to compete in the supply chain where everybody's constrained. We're going to be a bit better because we have our own manufacturing as well as use the industry. So it's going to be a competitive period in the industry, but overall, it's a rapidly expanding industry. It's going to be good for everybody, and we're just going to make it a whole lot better for Intel as we go to this next phase of our journey.
So that first clip was very useful to see how the vigor of Intel is reignited. So if we compare this back to the Bob Swan days, where it was very sort of financial and they weren't really focused on innovation, they sort of got lazy as their position on the market leader, really allowed AMD to capitalize on that and grow to the scale it is now. AMD posted some very good growth, and we can still see that they have been taking market share off Intel. And it's good to see that Intel is coming back, realizes the challenges they face, and is stepping up to meet the competition. This next clip is really useful to see how Intel is growing their business. So a new acquisition that's been in the line, you may have seen, is Global Foundries. So Pat Gelsinger here, we'll hear from him around the potential of this next acquisition.
To service that potential demand, 100 plus customers, Pat, do you need to go out there and make a play for Global Foundries? There has been some reports of that.
Yeah, of course, Brian, I can't comment on the rumors in the industry. I can say more broadly that this is a big, expensive industry to play in. The R&D demands are extraordinary. The capital demands are extraordinary for it. So you can't be a little player. And as a result of that, we do see that consolidation will be appropriate going forward as we see the industry players continue to refine to those that can play at these highest scales. So I do think consolidation will happen, and I think we'll be a consolidator in that journey. And we're going to continue to build out our own organic capabilities, but we're also not averse to considering inorganic opportunities as well as we go forward in this and a range of other areas.
So it was great to hear the potential reasons for the acquisition there, that the industry will consolidate. Intel is likely to become a large player. And also in this release from their new sort of innovation strategy roadmap that they've recently produced, Pat Gelsinger gave a great opportunity into the market share here and the potential new customers that Intel Foundry Services, or IFS, will have.
Qualcomm, Amazon, household names in tech, certainly. You say you have a pipeline of 100 other companies waiting to potentially use your foundries. Frame revenue. I mean, how much revenue can you generate from potentially 100 new customers, including Qualcomm and including Amazon?
Well, overall, the foundry business, there's a gestation time because a major new design on a foundry, and as we said yesterday, Intel 20A only becomes available in 2024. So there's a fairly long cycle until designs start materializing. We have some of our modern nodes available more quickly, and we'll start seeing revenue from some of those customers as soon as next year in the packaging offerings. But it takes a while to build up that revenue stream. But overall, the foundry business today is over $100 billion market, so we're going into a large market. I've set a goal that by the end of the decade that we want to be the #2 player in that market. So we're expecting that this becomes a large growth opportunity for Intel over that period. And yesterday's announcement was just a proof point on the way that we're making very good progress at the process, packaging, and now with some of our early customer announcements.
So that was great to hear. We can see the ambition Pat's bringing back to Intel, and also the large addressable market that they have. So great to see that Intel is going to continue to develop new growth opportunities as well as innovating their own chip designs. I'd highly recommend you to, if you are an Intel investor, to read through the recent notes for all this and the innovations that they are bringing in regards to the next era of chips being manufactured around 24, 25. So the last company I want to touch on today is Douyu. So it is a game streaming service similar to Twitch in China. Obviously recently, as discussed with the Alibaba holding, Chinese tech companies have been hammered by the recent whisperings of Chinese regulation. I was thinking earlier, I would absolutely love it if the whispers in CNBC whispered Chinese regulation every payday, just so the the price of these stocks continue to drop. So Douyu is, like I said, the streaming platform in China, pioneering esports value chain to announce its results, which we've got here. So we can see that the results have mainly been flat due to the large increase last year. That is not expected. It's similar with Huya, their sort of main competitor, with which they were recently going to merge, which has collapsed since, further reducing the price of the company. What I want to touch on here, though, is just 2 points. I'm continuing to research this further and not adding it to my portfolio yet. However, what is good to see is, even given this the streaming competition with Huya and the potential merger that didn't happen with Tencent, we can see that their average monthly users have continued to grow. So their revenue has not grown. I believe they continue to talk about how this is due to the less monetization just through the users in this last quarter. However, they are looking to optimize how they can actually improve the monetization from the users. But the user base is growing. And also what is good to see, so if we go over to Seeking Alpha here, Simply Wall Street, and we look at their cash balance, so they have an equity of 6.9 million Chinese currency. I'm afraid I can't remember what that is, CN. So we go to the cash and cash equivalents, we've got 7.46. So if we go to Google here and look at the Chinese yuan, sorry, that's the one, we can see that 7.46 roughly comes to 1.16. So obviously these are in billions, so 1.16 billion. If we look at the market capitalization of Douyu, it currently has a market capitalization of 1.3 billion. So essentially, you're buying this company for 150 million. Given that their recent cash flow, if we look at their recent sort of free cash flow generated, so this is from December 2020, we can see 587. So if we plug that into the currency calculator here, so we get 90. So they're currently trading at 1.7 times free cash flow to enterprise value. So a huge discount to their sort of assets that they actually hold. If we look here at the past growth, we can see they've had exceptional past growth. They've slowed in last year as expected due to the high increase. However, if we look at Huya, as I mentioned, it's experienced similar sort of decline, similar sort of slowing growth rates. However, as a fan of Twitch and a fan of esports, you can see how much China dominates this space, and the number of people and the growing platform only look to generate more money in the future. So it's one I'm going to continue looking at. It's got no debt, and the prospects are great, so I'll continue researching and hopefully bring you some more information in the future. So thank you very much for looking at this portfolio update. I'll bring you one again for August, and hopefully we will be back in the green, showing you some good gains that we've had in this last month. Thank you very much.